Let's start off with your thesis here, Bill. You're saying that the weakness in the housing market, that's a sign that the Fed needs to cut rates even more than it has already. So I want to put this in context, though. The Fed's cut rates by about 75 basis points over the last year, and mortgage rates are up about 15 basis points. So how is that going to help when the housing market, it seems to be really guided by some other factors?
Well, the housing market is one where it's very sensitive to both income, employment, and interest rates. Short-term developments are interest rate related, but the key is that households are short housing. The best estimates show that we're about 5 million homes too short. And housing starts, the creation of these new homes is somewhere on the level of about 1.3 million units a year, which is about 500,000 units below what's really needed to start closing the gap meaningfully. And so we really have to have lower interest rates in order to get people into the homes that they want to get into. And furthermore, most homeowners are sitting on mortgages that are about 4% right now. And with mortgage rates at 6%, that's just way too high to get these homes released and put back on the market and allow homeowners to start moving if they wanted to move.
All right, Bill, this is important because I know you know this. I want to make sure the whole audience knows this. The Fed doesn't control mortgage rates. They control the policy rate, which sometimes influences mortgage rates, but they don't have direct control over mortgage rates. Again, as we just pointed out, they've cut by 75 basis points over the last year. Mortgage rates are actually up over the last year with some ups and downs, about 15 basis points. I want to go to your data on housing starts. You actually sent us a chart. Housing starts over the last 3 years, they plateaued below pre-COVID levels. Why do you think an interest rate cut is going to change that? One of the issues is affordability. Some of the issues are that their income isn't growing as fast as inflation was, at least. That dynamic has kind of changed. How does an interest rate cut change this?
Interest rates cuts will release financial conditions and allow home builders to start building homes with lower costs. And so that's really one of the key ingredients to get housing started. You're absolutely right that income and employment and regulations, local regulations and zoning rules are some of the biggest constraints on housing right now. But given that those are slow moving, the fastest move that we can make to make homes more affordable right now is to try to lower the mortgage rate. And part of the financing of mortgages comes from financial conditions that are controlled by the Fed. And by the way, the Fed not only controls the short-term interest rate, but also controls the regulations concerning the way banks give out loans.
All right. One other factor in the housing market seems to be immigration as well. The available labor has been reduced significantly, which raises the price of labor, which raises the price of houses. We've all seen a lot of fluctuations in commodities, other things the Fed really can't impact or change. So, again, let's say the Fed does cut as expected this year, 2 more 25 basis point cuts. What are your expectations for the housing market? Will a series of cuts change this dynamic where we see mortgage rates move higher even though the Fed's cutting?
If we can allow banks to have looser financial conditions, and that includes both regulatory changes as well as the short-term interest rate changes, that will help a lot. Also, allowing adjustable rate mortgages to be cheaper than they would be otherwise allows people to start shifting into low rate mortgages. When I first got a home mortgage, interest rates were 13%. And I went to 5-year and 1-year ARMs, and a lot of people would be doing that if we had affordable adjustable rate mortgages, and that's exactly the area where the Fed can control.